in case you guys don't know who I am, my name is Shay. I go by Humble Trader. You guys might know me from YouTube. Who am I? I am Taiwanese Canadian, immigrated to Vancouver, Canada when I was little. And I don't know if anyone can see. You guys can see the photos here, right? This is me in Taiwan. That's my family. This is me in college. This is me in college. And that's me in college as well. I was like taken at 5 a.m. in the morning. So I went to college for film and VFX in California. And that's also in LA when I was living there. That's also where I started learning to day trade. Okay, so who am I? I'm Shay Humble Trader. You guys know me as the Humble Trader on YouTube. I'm from Taiwan, Canadian, and I'm in Vancouver right now. But I started day trading while I was living in Los Angeles. Okay, so how I started day trading. All I wanted was more money to buy those VIP tickets to music festivals. I was really big into those things like Ultra, EDC, Coachella, etc. And you can only get the fancy bathrooms, like the private ones, with the VIP tickets. If you go regular, which is what you almost always did, you have to use the porta potties. And those things are nasty, if you know what I'm talking about. So that's what I wanted. And I needed money fast because those tickets, they sell out, both the regular ones and the VIP ones. So, I started just like most people, I got the chat room alerts plan subscription, tried to get the fast money, and obviously that didn't happen. My account took a haircut, a pretty nasty haircut, and I still ended up just going with a regular ticket and deal with the gross porta potties. But even though the first taste of trading wasn't that successful, that definitely got me hooked into trading. And also this like EDC, amazing times. That's me in Los Angeles. These are my friends eating out of a can of beans in the like a parking lot of the festival. And I think at the time, living in LA definitely did something to me. Like, it was also around that time of my life that I wanted the money to afford more fancier things because you're kind of surrounded by all these wealth in Los Angeles. So I think, the situation of the location where I was in life, the city I was in definitely, both motivated and inspired me positively and negatively to want to make that fast money in day trading, I would say. But that's kind of where I was and how I started day trading. So during my learning process, the day trading and learning process, I quickly realized that, following alerts never worked. It might work once or twice, but it will never work consistently. And while the times where they would work, you'll make like $100, $50, $200. But when they don't work, I'll lose like $500,000. So, I would say this is something, if you're going through this as a beginner trader, this is very, very normal, right? But at the time, it just feels like the worst thing that could happen in the world. But, with my little $7,000 account, I'll lose like $100. Well, I made $100. I'll lose like $300 or $1,000. And then the days where I make money, it'll be like 100, sometimes 200. So definitely a lot of small wins, and the losses are bigger because you're just following others. You're not, like planning your trades. You're not doing the studying. I wake up 10 minutes before the market opens to try to like click buttons. So my year one, I was all red from chasing alerts, trading other people's ideas. Like we said, the wins were small and the losses were much bigger. So I stayed in a chat room to read others' thoughts process. I sized down and I started viewing the small losses as market tuition. I actually sized down a lot more. I was trading with like 10 shares, 20 shares. After the initial failure, I finally realized, okay, if I'm gonna, keep on losing in order to learn, then I want to make sure I'm only paying like $10, $20, $50 a day tuition. So I think that's a really important pivot point that a lot of traders, especially if you're new, entering the market recently, and you're frustrated after a month or two, you're not making money yet. I think that's very normal. And like I said, I didn't make any money at all in my year one. So it's a learning process, and you have to pay those upfront tuition. You have to do that. If you don't, you're gonna owe the market some money eventually. Let's say everything worked out for you for the first 6 months. You're gonna owe that tuition, because if it's based on luck, if it's based on following alerts, at some point down the road, that's gonna change. And when it changes, you're gonna be humbled. So I learned that really fast, that what worked for others didn't necessarily work completely for me. And that's the reason alerts didn't work. But what you could do is, take what you learned from the thoughts process, from reading others in the chat room, from others sharing their ideas in the community, on YouTube, etc. You can take what they're teaching you and make them your own, right? You have to personalize those setups to make them fit your personality, to fit your trading style, your patience, and your risk tolerance, especially. That's the most important one. Learning how to trade will make you money, but learning how not to trade will save you from big losses. So I think that's a very important aspect that we're also going to cover. You have to learn how not to trade. You have to learn for yourself that how to control your emotions and your discipline, because those are the things that are going to save you from big losses, right? Learning to make, I would say, at this point, that it's not difficult to make money from the markets, but it's very hard to keep it, because we're all human. We have human flaws, and that makes us do stupid things sometimes, and I still do them, even after so many years. So a big turning point during my learning and failing of the day trading journey is that I'm just checking my candles to make sure we're not setting the room on fire. Okay. Well, a big pivot in my trading journey is that I started making my own plans and taking risk management very seriously. That's, at some point, you have to do that for yourself, because if you don't get to point number 7, you're going to circle around 1 to 6 for like months and years until you really consciously start doing number 7 and start taking risk management seriously. Especially, your account will not grow until you manage the one thing you could control, which is your losses, because you cannot control your wins in the market. So no more random trades, no more I hope this works, I hope this stock continues going up higher, no more. If I ever have to say I hope or I wish in a thesis behind my thought process in a trade, then that's a no trade for me. No more of that. And no more, let's see what happens, right? What's the worst that can happen? I'm going to buy 2,000 shares of this penny stock overnight. What's the worst that could happen, right? I hope this works out. And most times when I have to say that, those trades never work out. So like I said, in year 1, I was all red. In year 2 was the year I finally broke even and started, finally know what I'm doing. I'm not saying like I started making big money right away, but at least I was break even and starting, like there's a apparent consistency and there's a pattern in my own trading behavior and my own discipline that I can fall back on. So in year 2, I broke even. And now 6 years later, this is from which month? October of this year, October 2010. The 6 years later, I'm making consistent profit from the market, opening balance, ending balance from one of my trading accounts. The other one is also in October. My other trading account, this is starting realized P&L, ending balance. October, that's my other account. November, this is November. Yeah, this is November. So these are my two main trading accounts. So we started balance, ending balance. What was I saying? November, center point, the starting balance, ending balance. So this didn't happen in year 1, year 2, or year 3, right? This happened 6 years later. So, and you guys remember the tiny, the small profits, the bigger losses. Now, I still lose. You guys know, like, I still lose money. But now, if I'm down, I don't go down a slope of consistent red days. Right now, I have the discipline, I have the discipline, the rules for myself to make sure that, even if I'm down from 1 day or sometimes 2 days, unfortunately, I can keep my P&L trajectory to steadily up. So this is in current month, December 2020. I still take, decent red days. This day was not fun, definitely not, but I'm able to come back. And this is just kind of show that, it's red days are normal, right? As a trader, you have to take red days, but it's how you come back from that. Afterwards, the days after, that really determines whether you're going to stay consistently profitable or whether, you lose 1 day and then you just steadily blow up the next few days. But this is after 6 years. This did not happen in my first year or second year. Okay, so that brings us to today's topic. I really want to talk about this point here, but let's kind of go over why do 90% of all traders fail. I didn't come up with a percentage. Somebody else did, but I believe it. I can see why 90% of all traders fail. There's some reasons came up to mind. They can't control emotions, ego, greed, chasing a dream or get rich quick, which is also how I started. So, I think it's normal for most people to start with number 2, like you want to get rich quick, but you have to snap out of that at some point. You have to, because if not, then I'm gone, right? No risk management, which is also very important, That's risk management and trade planning are the two things that really started to pivot my trading journey. Not like right away, not like a 90-degree turn right away, but it started a process, right? But today, what I really want to talk about is number 4. 90% of all traders fail because they spend 90% of their time chasing 90% of all hot stocks out there. And that's what I really truly believe, right? When people feel overwhelmed, it's because they're trying to watch 90% of the stocks that's gapping up on the day. Or they're trying to spend 90% of the time, flipping to, different tickers on their broker platform, just trying to find a trade. That's what failing traders spend most of their time do. And they only spend 10% of their time watching. The 90% of the time is clicking buttons, trying to find the next trade. Now, for profitable traders, for consistent traders, it's the exact opposite, right? We spend 90% of our time watching and waiting, and only 10% of the time executing the trades. So that's the biggest difference that I see after so many years of trading. From a failing trader, comparing a failing trader to a profitable trader. So that's kind of what I want to talk about today. Random stocks lead to random setups, which leads to random trades and random results. And that's why people will have these kind of P&Ls when they're first starting out. And that's normal. I went through that too. I'll be trying to chase these random stocks. And of course, they'll work on some days and you'll feel like really good. You're making money, $200, $500 a day. But on the days where it doesn't work, when chasing random stocks don't work, it's like, it's not consistent. So that's why it's important to narrow down the stocks we watch, the stocks we trade, and the setups, right? Like we mentioned earlier, you have to narrow things down, right? Instead of watching 90% of all the stocks that's gapping up, you need to be watching less than 10% of it. So that brings us to data tracking, which is very important. It's just a fancier way of typing crap up in Excel and you write numbers in it. You want to track two types of things. Track your setups, the stocks you trade, the setups that you take, and also you want to track your own trading behavior. Because one thing, the number one, you're tracking what works for you in the market. Number two, you're tracking how you behave while you're trading in the market. So both of these things I think are very important, but the first one you always want to start with is your setups, your number one, your trading setups. And these are just some sample images of how you can track it. Setups, maybe these setups, you have 1, 2, 3, 4, 5 setups. You track them. You look at your win rate. You look at your P&L, and you look at the number of trades you take per setup. And you figure out, okay, what are the top two that's working for you? Because you only want to trade, obviously, the ones where you have higher amounts of win rate and also that you're actually making money. You don't want to trade the setups that you're losing. I don't have a good example here, but like down here, you can do this on the bottom one on Trader View. You just tag your trade setups, and then you can see from this setup number A, you don't want to trade that because this one, this person does terrible at it, and that person is me. So I should stop trading setup A and focus my time on setup B and setup E. Right? You want to start tracking and tracking, do you do best at buying breakouts or buying the dips, right? If you put those two setups separately, for me, I would know that when I buy breakouts, my win rate is like 10%. But when I buy the dip, the win rate goes up drastically. And also you want to track whether you're actually making money, like risk reward wise, are you losing more or are you making more from this one setup? So that's very important. You want to track your setups. And number two, you want to track your own trading behavior. And we'll go over that in a little bit. Okay, so, we talked about that we want to track those things, but what exactly is a setup and what is a strategy, right? Because those are the things that we kind of talked about in a previous slide. These things, what is each one? Like, what is it? Scalp short, what is that? Mid-day squeeze, what is it? So you need to define that. You need to, you're kind of starting out from the bigger picture, right? You have all these setups, 1, 2, 3, 4, 5. But for each one, you want to go in and define that and find out what are the specifics for that setup, right? It cannot just be, if it's, up 20% or 60% on the day. It cannot just be that. So first of all, your setup and your strategy should never contain hope or luck. Like you cannot put money on luck. I'm saying, okay, this is a setup A if I'm lucky. It doesn't work like that. That's the most important part. Trading is an art, it's not a science. Nothing is 100% guaranteed to work. But you have seen, you must have been inspired or by recent, let's say charts breakouts happening repeatedly with similar stocks. For the example we're going to talk about today, we're going to talk about Disney stock breaking to new all-time highs in December, and we're going to talk about Snapchat, another stock that broke out to new all-time highs in 2 months ago, October. So this is kind of just talking about where your setups should be inspirations from. So these are recent market inspirations for our strategies, and it's one of the setups that I really like to take. And from there, let's say, I'm starting out the setups completely from scratch. I saw Disney charts, I saw Snapchat chart, and I've seen a lot of similar charts like these in the past before. So you kind of want to start from what you've seen working, and you work out backwards. You take a look at those stocks, right? For example, like this is the stocks that we're talking about, right? Disney, this is like a week ago, stock broke out to all-time highs. Let's say from this chart, we're very inspired. We're saying, okay, like this is, 165 all the way to 178. This is like a good 5% 6% move. I'm trying to do math really quick, something like that. And I just want to, let's say, I'm a new trader. I just want to catch a piece of it, and maybe even just $2 of it. Now we're looking at the charts. You're saying, okay, like, I wonder if there's a setup I can capitalize. And you look at Snapchat, you look at it and you see that it's the same way. Let's say, oh, wow, this is such a strong breakout. I really want to capitalize on this too. And this looks similar to the Disney charts that we saw earlier. Or you saw Disney first and you look at Snapchat, you're like, okay, like these two are very similar. I wonder, these two breakouts are very similar. How do I get a piece of it? How do I, work backwards to create a setup for myself that I can trade in the future, right? You're using past chart breakouts, past chart inspirations from the market to kind of make plans for the future. What was I saying? Okay. So, you saw those charts. Now we want to work backwards and find out what exactly happened on those days that they broke out. Fundamental catalysts, what do they have in common, right? Do they have news? Do they have earnings? Is there like a new partnership deal with Amazon, Roku? Like, well, what costs? What's the fundamental catalyst that caused the breakout? So that's important. And we also want to look at the technical analysis, right? What do the charts have in common? And, I always start from the daily charts. What does the daily chart look like? What is the, what is the key resistance to break? And how many percentage was the run after that breaks, right? Does it keep on going for multiple days? Maybe we're trying to figure out a swing trading strategy here. So you always have to start with what's already happened and what you think would continually to happen repeatedly in the future. Maybe not every single day, but you see it enough that you can work backwards. You have enough sample sizes of stocks to work backwards for. So for this example, Disney and Snapchat are the ones that we're going to take a look at. We want to first of all figure out the fundamentals and the technicals. What do they have in common? What do the fundamentals have in common? You want to figure out all these things, and then that's how you can kind of create a more concrete trading plan for the future. So this is what the chart looks like. You can see the stock was trading at all-time highs. It basically gapped up. I guess on this day, gapped up to around. Can you see? Annotate, highlight. Oh, there we go. Okay. You can see the stock basically gapped up. Gapped up to all-time highs pre-market on this day, and we can take a look at, okay, this thing, you can see it dipped at the market open. This is also pre-market lows, right? Very simple pre-market lows area. The rough area around what I want to say 165. It dipped down to. It spiked in the morning, yes, quickly, but, we had a tiny profit taking. These are 5-minute candles, the profit taking for the first 5 minutes. And you can see once after 5 minutes of the open, 9:35, we had the first green candle, and the thing just kind of reclaimed, this is VWAP, by the way, this pink line, reclaimed VWAP. And then on the 5 minutes, it never pulled back down after that. Okay, then we can kind of think, okay, so if we're expecting, stocks, that have similar news as Disney, which at the time was that they have a new, I forgot. What was the HBO partnership? My God, it was only a week ago. It was a fundamental catalyst. Disney. Was it like, oh yeah, they're projecting more revenue to their the online stream subscription service, right? The Disney Plus, yes. More revenue, more subscription numbers, future projections for the company, the earning projections for the company is going to be increased drastically in the future. So stock gapped up to new all-time highs. So that's the fundamental reason. Now the technical part, you can see we dipped to pre-market support level, this rough area, and the stock just climbed back over VWAP, broke out above the high of the day breakout. You can see we broke out, we dipped, to the high of the day area, and then we go up higher for like the rest of the day. So that's like about 8% move, we said. So, that's the first observation from the stock. So, from that, we have gathered the fundamental reasons and the technical analysis part. Now, let's take a look at Snapchat, right? You can see, something similar. And obviously, I know we're just doing 2 examples here. Now, in October, it was, if you look at this chart is Thinkorswim. On this day, this icon means they had earnings and guidance, really the quarterly earnings report. So on this day, I remember it was earnings beat, revenue, earnings per share revenue, and also guidance up. So, similar fundamentals, not similar fundamentals, similar fundamental news catalyst as Disney, right? The company is projecting increased revenue for the future quarter. So this thing, you can see very similar chart. We have, first of all, similar fundamental catalyst and a chart gapping up to new all-time highs. Gapped up here pre-market to 35 from a close of, $28. That's a very significant gap. But you can see, pre-market, we sold off some, to some pre-market support right here. At the opening candle, these are also 5-minute candles. We, had a spike. We dipped a little bit. These are tiny, tiny dip levels around 34.50. Right, made a dip, didn't touch exactly to the pre-market low levels, but you can see a dip, broke out above the high of the day after that first 5-minute dip, and then we just climbed to new highs. I would say this is another snatches. How many percent? 10%? Yeah, that's 10% of the move. If you do the math, 35 to 38, that's 10%. Something like 9 to 10% of the move. So you can see a similar setup here. I was saying something similar. And even though I only have 2 examples here, if you just go do some homework after this presentation, you'll find very similar setups, very similar charts with these larger cap stocks. So the setups has to always be inspired from usually recent charts. So that's kind of what we were doing, right? We looked at the fundamentals, we looked at the charts, they look similar, and we worked backwards to create a setup. Now, what I don't want to do is kind of like this. The fallacy of using too much data tracking without a thesis, right? You always need a thesis first. This is something that I worked with another trader that I work with regularly. He would make these really fancy looking spreadsheets. And then I'll look at it, but I always wondered, like, what exactly are you tracking this for? Are you gonna use this to, make a setup of your own, or you're just tracking this for fun, right? You're tracking all these things, which is good, right? The floats, the ticker, the date, day one news catalyst, previous day close, pre-market high, all these different levels. Like, it's good to track these things, but unless you're actively using them for a setup that you're working on, you're kind of just, can you generate anything in common from this besides the fact that, lower float stocks and spike, that's the only data I can see from this tracking sheet. So that's the reason you always want to start with thesis. You don't want to just be tracking everything for the sake of tracking because, you saw somebody on YouTube tell you to do that. You saw humble traders say track your setups and you start doing this. You should be, but you want to track with a thesis. You don't want to just track anything random, right? This kind of just looks like the lower float stocks with the COVID news, in April, May, they spike, right? Unless you can see something else from this data sheet, to me, this is useless. And I worked with him on this thing. No, I'm sure he, I don't know if he's actively using this now, but to me, I don't see anything, right? And it has to be something that you can see. You have to start with a thesis. And that's why I'm a very visual person. And that's why I always start with, the chart. The charts that we talked about earlier, that's how I personally do it. Maybe you look at this data sheet, you can just see these charts in your mind, but I can't. So everyone learns differently, and you have to find out what works for you. But I get a lot of questions from traders sending me these Excel sheets, sending me these journals, and ask me, Shay, do you see anything from this? And the answer is no. So I don't see anything here. And that's just me, right? I learn from the setups, from the charts I actively look at every single day, and I work backwards to get the numbers I need. So that's just kind of the process of how I look for setups. I don't start with this thing. I start with a chart, right? Maybe if you go in and look at these charts, all these tickers, maybe you'll see something. Maybe you can find a commonality there in like we talked about earlier, the fundamental catalyst, the technical chart, how the charts are setting up, the technical analysis aspect, and then you work backwards to create a setup for yourself. Okay. So, continuing from what we talked about for Disney and Snapchat, that's our setup, right? How do you create a trading plan around that setup? Again, hope and luck, it should never be part of the plan. If that's part of the plan, the plan is probably going to fail. So the trading plan should have the following things according to the setup, right? Everything is centered around the setup. The setup is that what we saw earlier, the thesis is that large cap stocks with positive earnings projections should break out higher. That's what we saw earlier on the past, only the two examples that I brought out, Disney and Snapchat. Okay, so we saw that. Now we kind of take a look at the technicals. How is the chart setting up on the daily and intraday, right? The stock is breaking out to all-time highs, right? That's the setup. That's how the setup, the chart is setting up technically. Now fundamentally, they have positive news, positive earnings projections. So that's the fundamentals. Entry, we saw that earlier. Pullback after pre-market high breaks, or dip to pre-market low support, right? That's kind of what we saw earlier. When I went over, I drew some ugly drawings around the pre-market levels, the top of the pre-market levels. You can see pre-market. This is it's pre-market low right here, pre-market highs, right? Those are the two levels that we're using for our setup example here. Those will be the entries and the exit. Exit, profit taking, we saw we can make about 8 to 10%, only if the entire move is captured, right? But even if you don't, you can still capture maybe a point or 2 points per share. So that's kind of like what we're looking at for the setups. And the stops will be the breakdown of pre-market high support or pre-market low support, depending on your entry. That's kind of what we saw earlier, right? The stock dipped to pre-market low level on the 5-minute chart, and then just reclaimed higher, broke out about pre-market highs, and just climbed up all day to 6% to 10%. So that should be this is like the simplest trading plan that you should have for yourself. A thesis, a technical chart, a fundamental, for me, that's very important. There's people who can trade without the fundamentals, and that's fine. But I think these are the bare minimums you need for your trading plan. You need an exit, you need an entry, you need a stop. Right? Stop as in you're planning out your risk. You're prepared for, let's say, if Disney, falls off the bottom, I'm only going to lose, let's say, $100. That has to be planned out. So it has to be as specific as you could. And that's also the reason why people like indicators. Indicators like those MACD, RSI, and all that stuff. That's the reason people like them, because if they give you like a definitive answer, right? If you put in, let's say, including all these things that we just talked about, let's say you use, RSI, RSI at 20, that's where you go long. Let's just say that I don't do that. Don't do that. That's just an example. That's the reason people like it, because you can line up so many different factors besides just the entries, the exit, and the stop. Right? That's the reason a lot of people like to use VWAP. I use VWAP, not for the entries, but I use that as part of my trading plan, as part of the setup, right? It's another one of these criteria you can add for yourself. So the more specific you can make for your trading plan, the more precise your entries, your exits, and how you select the stocks would be, right? Well, no longer, by having these things, let's say if you add another few indicator to part of your setup, by having all these things, 1, 2, 3, 4, 5, 6, 7, 8, let's say you have 8 different criteria for the setup, right? This stock that you're selecting to trade on that day is no longer part of the 90% of all the stocks gapping up. Right, because you're specifying, you're narrowing down the stocks that you're trading on the day. I would argue it's less than 10% of the stocks that's tradable on the day with volume. So you're narrowing down your focus. That's what we're doing. You're narrowing down your focus. You're isolating the stocks that fit your setup. And this setup, if you were tracking, like we talked about earlier, this setup should be the ones that can give you, at least 60, 70, 80% win rate. And that's how you narrow down the stocks you trade. You're no longer trying to trade random stock that's just popping up on the day, because those will be the ones, I guess I don't have enough examples here. Those will be the ones that will give you random win rate. And because those setups are random, you don't have the specific criteria that we just kind of talked about. So that's how you avoid random results in trading. You want to narrow down the stocks that you're putting your money into. This is your hard-earned money. You don't want to just throw it into anything that looks good on the day, right? You want to respect your money. So, by having the specifics listed out and planned out on your platform before you enter your trade, you're doing what the 90% of the traders don't do, right? Most of the traders, they follow chat room alerts, unfortunately. They have a scanner and they just jump into whatever's popping on the scanner, right? That's not enough of specifics for you to consistently make profits on. So you want to spend 90% of your time planning for your trades, for the setups, waiting and watching, and less than 10% of you're spending 90% of your time waiting and watching to trade less than 10% of the stocks in play that fit your setup. Right? Instead of spending only 10% of your time planning and 90% of your time clicking buttons, you need to do the opposite. You need to spend more time watching and waiting and planning, and only about 10%, actually executing your trades, long or short. So that's a very important part. And, this is something you have to actively and intentionally do to kind of stop, to kind of try to make that transition. Like, it's not something that you're gonna one day magically be able to do. This is something you have to actively train your mind and your body to stop jumping onto every single stock that's popping on the scanner. You have to do that, because either you do that, you force yourself to do that, or you lose all your money before you hit that point. And that's just a reality. I think most people eventually, if you trade for a year or two, you start, hopefully for most people, you're going to start finally realizing that chat room alerts are not going to work. Just jumping onto anything and everything on scanner is not going to work. But you need to wake yourself up. You need to wake up, and you need to actively try to transition into doing these things that doesn't look fun. I'm sure a lot of you are falling asleep right now because, oh my God, it's like a lot of these things, a lot of extra steps that I have to do before I even enter into a trade. But you have to do this. I mean, you don't have to. I have to. If I don't do this, then my account's not going to be too happy. But these are the things that I do for myself. And these are the things that's been keeping me consistent. And I did none of these the first year. I can say that. I did none of this, and that's why I was in deep red. I was just clicking all the buttons and thinking I can make money. Nah, it doesn't work that way. So these are just some recent executions I did on that setup. Exact same setup that we just talked about, right? This is not the most, like the setup I just showed as an example, it's not rocket science, right? It's pretty basic, I would say, but it's simple, but it works really well in the market. You can see, BA, I forgot what, I think it's last month, had the similar fundamental news that we talked about. The stock, had a tiny dip to pre-market levels and just reclaimed the high of the day, pre-market highs, and pre-market high, pre-market low. Exact same thing we talked about. I don't have the daily, but if you look at the daily on this day, you would see something similar. And the stock just went up to, from 229 all the way to 230s, 240s. So 239, 240s. So exact same setup that I showed earlier on Disney and Snapchat, and this is just an execution of that 2-minute chart. Okay, next, similar one, Baidu, which we traded last week. This is an uglier chart, but if you look at the stock on the daily chart, this day right here, this day, this is the day I traded it. And then, very similar thing, right? This is at the open, spike, dip, I got in long, long and added more on the way up and sold into the pushes. So it's an exact same setup, exact same execution. And these are the things that's repeatable for yourself. And the reason I can execute them the exact same way is because I've seen the same setup over and over again in the market, right? And that I'm just, at this point, after so many years, that setup is like ingrained in my mind. But so that's why, this is actually one of my favorite setups. And I still trade them every single, or maybe not every single day. But I would say there's very constant opportunities like these. And this is something that I've traded. I have enough sample sizes and enough screen time experience to see this setting up, and also to execute this trade. But this is not something you're going to magically master within a week or 2 weeks. It's something you have to actively practice and trade and collect enough sample sizes. Okay, let's keep going here. Marna, another example, another long trade. I short it at the open. Shorted right here, covered, reshorted some. The short was a loss, and then I went long and finally did better. Long, same idea, right? You can see this one actually never dipped to pre-market low level, but it broke out right away. I got long and it sold into the pushes. But it's a very similar setup. If you look at the chart, if you look at all the tickers I mentioned earlier, the chart looks similar. Intraday and also technicals. Intraday and daily, and also the fundamental catalyst we talked about. Okay, so, that's what we said, you want to start tracking and back testing your setups. You don't want to reinvent the wheel, right? You can start with proven inspirations from the market, proven setups, like we said, with the thesis, and learn from experienced traders. But you need to personalize their setups to fit your own style. Right, what I talked about today, you could trade that, but you probably need to go in and fine tune it to fit your criteria. Like maybe use the indicators we talked about, so you can add those to part of your trading plan, your trading setups. After enough sample sizes of 2 weeks of trading daily, you should see enough data on your setup performance. So earlier that the large cap breakout setup, let's say it's this setup here, right? That's it. You want to start tracking this specific setup along with everything else you're trading. And you want to see the results, right? Let's say for this setup, I only have 45% win rate. And the sum of profits like this, relative to the rest of the setup, you want to start figuring out what you should focus on every single day. You need to improve on the best performing setups for yourself. You can, how do you backtest? And backtesting simply means going back in time to practice the same stocks that we talked about. Let's say, after today's conference presentation, you go and look for more similar stocks that, you saw Shay showing Snapchat, Disney, Baidu. What are some other similar ones? You can go back and practice. You could use DAS Trader Replay. They have that option for, going back and practice your executions. basically simulator backtesting, right? Or you can use Thinkorswim on demand. They have a similar feature. It's a little bit more buggy and slower, but you can also do that on Thinkorswim, right? You can pick the dates. Let's say you want to trade Apple October 29th, 2010. You could go back and do so. So that's what these two tools you can do to backtest your strategies. You need to go back and practice the execution. Save the charts, print them out, and annotate them. Okay, so that's important, right? You want to track your setups, right? That Disney and Snapchat setup could be just setup A, right? And that's one of the setups you're tracking, right? You're tracking this you just want to track these enough to see what works best for you, right? It could be setup A and B, or it could be setup A, B, and E. And A, you should just completely avoid. You want to stop trading the worst setups with the lowest success rate in the P&L. That sounds like a no-brainer, but a lot of people still do it. Like I used to buy these like breakouts, as you guys know, buy breakouts on these low float stocks. Until I really tracked it, I realized, oh my God, the win rate is only like 40% when I buy breakouts on these low float stocks. And overall, I'm net negative on the setup that I'm trading every single day. Buying at $1, sell at $1.50. That sounds simple, but the risk is higher than the reward. So I stopped doing that. And that has helped a lot. Remember what we talked about earlier. Learning to trade will, sure, make you money, but you need to learn how not to trade. That's also important, right? And that's why we need to also know what setups we should avoid. The ones that's making you or I red. So setup A, I should stop doing it. Right, that's the sort of things you need to track. How not to lose money. That's just as important, if not more important, than how to make money from the market. Okay, so we talked about tracking the setups, tracking what works for you in the market. Now you also need to track your human behavior. That's very important. You need to create enough rules based on your own behavior. Since trading is 90% psychological and 10% technical. We're human, right? We do stupid things as human beings. So you need to create a list of must-follow rules to make sure you can intentionally control 90% of all actions. Because unless, if you could have your setups down, but if you're reckless, if you trade on emotions, it's very easy to kind of steer off grid, off rail. Steer off rail from your trading setups. Track your behavior just like your setups, right? Make them separate. Start tracking stuff like what time frame do you make the majority of your profits? What time do you start giving back profits? Which days of the week do you perform the best or the worst? What exact event usually causes you to start feeling emotional, which is the same thing as what's your trigger? What makes you feeling on tilt, right? You need to know all of those things about yourself. You need to know your own trading behavior. You need to know your own personality, your psyche, just as much as you need to know about the setups that we talked about. You need to know these two things. One is really relative to the market, which is the setups related to the market. And the other one is a human factor. You need to control yourself because at the end of the day, you're the person clicking the buy and sell button. You're responsible for your own trading account. So you need to control yourself. If you lose control of yourself, it doesn't matter how good or how successful your setups are. The person clicking the button is going to be swinging up and down. So this is just some examples of my own behavior. I make most of my profits within the first 2 hours of the open. So usually that's where I should allocate more size. I start losing money after about 11:30 a.m. So I start taking a break midday during lunchtime, especially because I'm gonna lose money during the midday. So why stay around for that? I usually do worst Monday and Friday, so I'm extra patient on those days, or I try to be. And my emotional trigger is that when I see my thesis was right, but I got stopped out 10 seconds before the trade worked out. So that's what triggers me to start feeling emotional. So I have this rule of after red day, I size down to focus on building my confidence back. So these are the rules, and just some of them. I have even more rules that pertain to my own trading behavior, because I know that in the past, if I don't have these rules, these are the reasons or the factors that cause me to give back profits, to lose money, right? So you want to kind of control how you lose money too, right? You want to try to be away during the time you lose money and kind of be aware of those emotional events that's going to cause you to lose money. You need to know yourself very well to day trade, to be in this trading business. Okay, so key takeaways from today's presentation before we go to Q&A. If you want fast money, if you're lazy, if you want handouts or alerts, you should probably not be in this game, right? I think we all start out, most of us start out, sure, wanting the fast money, myself included. But like I said, if you don't snap out of that sooner or later, either you're gonna, lose enough money where you cannot be part of the market anymore, or you're gonna continue in that cycle of small wins, bigger losses. Trading requires hard work and time, so you need to start taking responsibility for your own account, start learning, tracking, and backtesting setups in your own behavior. You have to accept the fact that you will lose money many times, and you will continue to do so. I still lose money, right? But you need to trade small and treat your small losses as market tuition to absorb screen time and experience. So that's basically kind of, you need to, at least when you're first starting out, the first 1 or 2 years, you need to treat that as going to school, as going to college, right? You pay, trade small until then, but you should accept the fact that you're going to pay, $10, $50, $100 per day, right, to lose in the market in order to learn how to trade and profit later on. It's so important to kind of, treat your initial losses early on as market tuition. That's very important, because if you kind of just give up on month 2 or month 6, you'll never get to that point where you have enough screen time to kind of start digesting everything down the road, let's say in a year. You need to give yourself the luxury of time, and that's something you have to allow yourself to do. And that's the reason you want to trade small until then, right? You need to learn first and profit later. Many things you learn in your first 1 or 2 months will not make any sense. Like obviously, it's like learning a new language, right? Until you've collected enough screen time to digest the material, right? Trading, how to read charts, how to analyze everything is really like a new language, right? When you start learning, when I first started learning English, I don't jump straight to reading Harry Potter, right? I need to learn how to read English first. And how I learned English, it took, obviously months and years, but now I can read Harry Potter perfectly, I hope. Well, maybe not perfectly, but you can now I can read. But until I get to that point where I learn the language enough to read a book, I will not I cannot just jump straight from A, B, C, D to reading Harry Potter, right? That's kind of the point I'm trying to make. You need to learn first and profit later. You need to learn how to read the market with your first 6 months or a year or even 2 years, and start capitalizing on what you've learned. But most people don't get to that point, because most people give up or they blow up after 6 months, and they haven't even learned the language yet. They haven't even gotten started. And just kind of repeat what I said earlier, 90% of traders fail because they spend 90% of the time chasing 90% of all hot stocks out there, right? You need to narrow down your stock selection and your setups and your trading behavior. Setups and strategies may change, and they do change, but the skills you learned from observing the market, your patience, is discipline, and the rules are what's going to allow you to adapt and change with the market. The strategies may change, right? Over the years, certain setups and certain things don't work 100% as they did on my year 3 or year 4. But I've learned to adapt using the same skills we talked about earlier. Observe from the market, work backwards to backtest, and that's how you adapt. Adapting in the market is a skill, right? No one setup and strategy is going to work exactly 10 years from now. Right, the setup I showed you earlier, we may have to go in and tweak it in 6 months or a year because markets change. But you will have the skill and the patience and discipline to adapt with the market. And that's how traders survive, right? You need to have the same discipline that you had in year 4 and the same discipline. You need to use the same discipline in year 5, 6, 7, 8, 9, 10 to adapt to the market. Okay, so learn first, profit later. You guys can learn more about me on my YouTube channel. I have a day trading for beginners playlist. I just reordered everything yesterday, so you can take a look from that. If you go to YouTube, search Humble Trader, you will find me. You'll find my trade recap reviews on large cap and small caps. You can sign up on my website for a free weekly watch list on the stocks to trade on small caps and big caps, and it's kind of like an overall market sentiment recap. And you can also learn more about how I trade and all these more additional education material on my website, humbletrader.com. So with that, I will take any questions you have for me.
Okay, thank you so much, Shay. Can you all now hear me, because I just unmuted myself just to do a quick check?
I can hear you.
Okay, cool. Right, let's get started with the Q&A questions. Okay, so let's see.
So how do I start with the questions?
Don't worry about it, right? This is where we'll handle the logistics. We'll kind of pick the best questions that will deliver the most value, and I will just, facilitate the session with you. So, okay, let's see. First one from Daniel, right? So he says, hey Shay, you started with Forex and then went to stock. Do you still apply Forex principles to your stock trading? And do you still trade?
I never traded Forex.
Okay, so yep.
I don't trade Forex.
Okay, that's a perfectly fine answer, right? Maybe the person got mistaken. Okay. Next one from Christopher, right? Did Shay go through a paper trading stage after her losses in year 1?
Yeah, year 1 was all red. I blew up, I think, 2 accounts in year 1. Yes, all red.
Okay, great. That's moving on. Next one.
It's normal too. So if you go through that, you're not alone. It's normal. That's a market tuition you have to pay.
Okay, cool. Moving on, right, from Kenny, right? Do you prefer going long or short, and do you find one to be easier or more reliable than the other?
So I do both, like we talked about the setups, you have to have let's say your long setups and the short setups, and you start tracking them. And then you'll see that in your journal that I kind of showed you earlier, you can see whether you're better at trading long or short. So you need to find out I wouldn't use the word easy, but you need to find out what works best for yourself. But for me, I have setups on longs and shorts that's, high success rate for myself. So I do trade both. But I would say, at this point, probably 60% are short, 40% are longs. But I wouldn't say one's easier than the other. Both are important, I say. None of them are easy. So yeah, there's the answer. Oh. But you need to track it for yourself though, right? My answer is not going to pertain to you because you and I are different traders. We have different personalities.
Okay, cool. Next one from Louis, right? Shay, do you modify the share quantity or entry price depending on the positive fundamental catalyst information, or do you recommend to use that information to help confirm or cancel your previously planned setup?
So I vary I think there's like 2 questions in there.
Yeah, that's right.
So first of all, for each setup, let's say a setup A and setup B. Setup A, you have, let's say 70% win rate. Setup B, it's only 60% win rate. And for yourself that you are better at setup A. So I will allocate more share sizes for setup A. So let's say, if my size for setup A is 1,000 shares, right? I'll do that. And the next setup, I know I'm not as good at it, but it's also pretty good. I can still make money from that. Then maybe I will only use 800 shares. So that's how you should do it. You find the best setups and you size into the best ones. And the secondary, that's also good. Maybe you see more often than setup A, less share size, but you still trade them. So that's the one way I do it. Also, as for share size adjusting, I adjust my share size according to the risk. So if a stock you have to risk $1, and another stock you only have to risk 20 cents, I would, of course, size differently for each one. So maybe the 20-cent stock I will size 1,000, and the $1 share risk stock I will use 500. So you have to vary it for that.
Okay, moving on from Karen, right? Do you trade options contract on the side?
I don't day trade options. I used to, and that's another thing. That's also another reason I blew up in like my earlier 1 or 2 years. So I don't touch options. Okay. I try not to.
Okay.
But I don't day trade options.
Got it.
You need to find out what doesn't work for you in the market, right? If I find out in the past, if I trade options, I lose money. So I just stop trading that altogether.
That makes perfect sense. Next one from Michelle, right? Hey Shay, you talk a lot about the psychology of trading. Are there any books that you recommend to build that? Yeah. Are there any trading psychology books that you recommend?
Yeah, so the first one, this one is not really for trading. It's for Atomic Habits by James Clear. That's one that's going to help with your personal psychology and discipline, but it's not a trading book. But that one, I still highly recommend it. The second one is called Trade the Trader. If you later go to my YouTube and you search Humble Trader, trading books, I actually made a video on that. So Trade the Trader, and also... what's the other one? I forgot. I talk about like 3 other books in that video. So these 2 came out to mind, but there's like 3 other ones I can't remember right now. But if you check my YouTube video, you can find it. Okay,
got it. So the best way is just to go to her YouTube channel and search for the complete list of books, right?
Yes.
Okay, moving on from Sophia. Hey Shay, can you give us more examples of the rules you follow for triggering emotional events? You mentioned you have a lot more behaviors you've noticed, and I'm curious because perhaps a lot of us can relate.
Yeah, so the trigger for me, the emotional trigger is like I mentioned earlier. So it's if I have a setup and if I'm about to go in a trade and I'm in the trade and I got stopped out, maybe I bottom ticked it. I got stopped out right at the bottom and then stockers took off without me, and that's happened. So that's the event that frustrates me. So that's the most important one. There are a few others, like if I have this rule of if I trade the stock 3 times and 3 times I have losses, small losses or big losses, I take off the stock off my screen. So I stop trading it. So that's my rule of 3. If I try 3 times, it still doesn't work, forget it. Like today's not your day. So that's another one, another important one is to size down after a red day. So those 3 rules are important for me. And also, another rule is I always need to know why the stock is running or gapping up. If I don't know, there's no news on the stock, I'll either avoid it, or sometimes, just avoid it. Yeah, I always need to know why it's up.
Okay, got it. Next one from Vincent. Do you prefer to scan after market or pre-market to filter down to a reasonable amount of stocks?
Nowadays, it's all pre-market. But when I was trading part-time in my year 1, 2, 3, I would do the scan after hours and also just look at what was in play and prepare the same trading plan we talked about the night before, and I'll trade them tomorrow, the next day. So nowadays, all pre-market, but when part-time trading, I'll try to prepare them the night before. So that will be in the evenings after hour.
All right. Then another related question from Kenny, who asked about you trading full-time. Basically, he wants to know, right, how did you make that transition from part-time to full-time trading?
Oh my God. So first of all, the most important thing to always keep your job until you need to need to quit to capitalize on your trading. So I never thought I would actually quit my job. I kept the job, for many years, and I used the job and trading to kind of save up like a 1 year worth of spending for my life. So let's say I need to live $40,000 a year. So save that up, have that aside outside of your trading account in my bank account, right? My trading account is separate from my bank account. Let's say I need to live on $40,000 for the next year. Have that in your saved in your bank account. And of course, that will be after you have some consistency in the market. You need to be able to prove yourself that you can make that 40,000 from trading. So, let me kind of reiterate. You need to make enough from trading to cover your 1 year of expense and also have that 1 year of expense saved up. So that's kind of, that you need to make sure that you have something to fall back on in case trading fails. And actually for me, I tried quitting, and I just got laid off from my jobs for certain periods of time. And those are the times I tried to go and trade full time. And, when I did that and didn't have the nest egg of, a certain savings in my account, I traded terribly because there's nothing, like emotionally, there's nothing to fall back on. Everything that pays for my bills at the time is, some other sources of income, but those are small, and also trading. And it's very stressful when you have to rely entirely on your trading. You don't have anything in your savings. So that's very stressful. So that's why I always recommend you keep your job. I didn't quit my job until I have enough saved up where I can say, okay, I have like 2 years worth of spending in my bank account for me. But I think 1 year should be enough, but I want to be safer, so I had 2 years. But I wouldn't just jump straight into trading full time right away.
Oh,
that's my suggestion.
Okay, thank you for sharing. Right, I totally agree with that portion you just shared. Next one from Sabine, who asked, right, with a small account, what kind of stocks should you watch for swing trading until you are not under the PDT rule?
So I would avoid the small cap penny stocks. That's the thing I would avoid if you have a small account. So those are the ones that the small account traders, myself included, right, when I first started, usually go to. But unfortunately, from my opinion, the large caps and the mid caps are more stable, and there's more consistent setups that you can trade on a consistent basis every single month. Whereas in small caps, they're sometimes they keep on going up and sometimes they just keep on dipping. So I would avoid the small caps. So I will maybe trade the mid caps and large caps around the $20 share price range, $20 to $30. I think that's a good amount where you can take even 50 shares, right? Even if you take 50 shares, if it moves $2, that's $100. That's enough to start building your account. So that's why I would focus on. Just ignore those slow float penny stocks. Seriously, avoid those. Those will take your account to a chopping board and chopping half.
Okay, so moving on, right, from Nicholas, right, what habits or factors transform you into the trader you are today since when you first started trading?
So most important is having a routine, having discipline, and also having these rules, right? It's one thing to write them out, and it's another thing to follow them. So I think the most important thing is that I have a routine in my life. I'm a very routine-based person. I don't like if my friends call me out to go have dim sum today, it's not on my calendar. I don't like to do that. I hate it when I have to steer away from my calendar and from my daily routine. So I'm a very routine-based person. I'm not spontaneous at all. And I think that really helps me out in trading too, right? In trading, I have this, this routine of things I have to do to start the day pre-market. So that, how you carry out your life in real life outside of trading is going to affect how you trade while you're in the market. So I think I would say, to make sure your life is stable, both emotionally, personally, and financially, and working out too. Have to work out, working out trains your body and also trains your mind. So, those things really helps me out to have a routine.
All right. And we'll just, have another 3 more questions for Shay before we let her go. So the third question, right, is from, this one is from Elwin asking, what are the most common indicators that you use for your setups?
Only VWAP and volume. I don't use a lot of indicators. And VWAP, I don't even use it for entries and exit. I use it as a guide, sentiment only. So, you're not going to see a bunch of lines and graphs on my chart. It's just volume, the candlestick chart, and one VWAP. That's it.
All right. And the second last question for you is from Greg. Do you do any back testing when you have a thesis and resulting strategy, or do you trade with small size and see how it performs?
I would do both. Start out with small share sizes to test them in real time. But also, I would also go back in time and test them, with the back test, the dash trader and the on demand. I will still do that because I think even with just a tiny amount of share sizes, it's human. We can't help but being attached to that $5 or $10. So I think if you're testing it in real time with even 10 share sizes, there's still some emotions involved in that. So that's why using those simulators will still help to give you a clearer mind. But I would do both.
Okay, and the last question for you is from Ken, right? Hi, Shay. Basically, he mentions that how do you actually encourage yourself, to trade again after blowing up your account?
I think this is where you actually have to be passionate about the market, because if everything about the market is making money, and I'm sure that's everyone's inspiration, that's important too, and I understand that. But I think during that initial 1 year, 6 months, 1 year, or second year, you have to have that. You almost have to be a little bit crazy and addicted to the market to keep on wanting to come back. Because I actually quit, after blowing up, twice, 3 times. I quit. I thought I quit twice. I think I mentioned before. And each time, I'll take like a month break or a few weeks break. But I keep on coming back to the market because there's just something about it that draws me to it. It has to be about passion at that point, because no sane person would keep on trying to go back to something that they consistently lose money on. So I think you have to be actually passionate about it. And the time is gonna test you that. If you blow up your first $1,000, $2,000 account and you're like, that's it, I don't want to come back, and you never do, then you shouldn't come back. It has to be more than just the money aspect that draws you to it. If all you want is to make money, I would say most people will fail in year 1 and 2 because you just want the money. You don't have the passion to, continue studying the market and tracking your setups after hours, even though you just lose $1,000 on the day. You almost have to be insane to keep on doing this, and that's why trading is not for most people. I feel like everyone has to be a little bit degenerate, a little bit crazy, and a little bit, like that taste of risk to kind of want to continue in this day trading journey. I really do feel like you really have to have some mental issue to stay with it, and I probably do. So I think that's the thing. You have to be passionate about this. There's something I learn every single day from the market, and that keeps me waking up at 4 a.m. every single day. And today is a Saturday, I still woke up at 4 a.m. So it has to be the passion, man. Like if it's just the money, it's not enough to keep you want to come back after losing like $10,000, $20,000. You have to be insane to keep on doing this. And that's why I have mad respect for everyone here who show up. We've all lost money. I've lost a lot of money too. But despite losing, despite all that pain, you still want to come back to trading. So that's passion for you. You need to be insane and passionate enough about this to want to wake up at 5 a.m. on a Saturday morning to listen to me talk. So, if you're here, I would say you're passionate about this and you kind of understand what I'm talking about the addiction, about the insanity, yet we still come back to do this. So that's kind of what I think of why I keep on coming back.
Thank you for your answer. I really like that, right? And thank you for waking up so early to do this presentation, Shay. Thank you so much. I really appreciate it, as well as the audience, right? So before I let you go, I need you to do one small thing. Please make me the host so that the rest don't get disconnected. That's the only thing left.
Thank you everyone for watching, and thank you for taking your time doing this, and thank you Rainer for inviting me to speak to everyone here.
Pleasure is all ours, Shay.
People at one point.
Thank you so much.